Welcome everyone to another episode of Let's Talk SEZ. Now, the Jamaica Special Economic Zone regime has a particular feature in it which prohibits existing business that is to say businesses already established in the domestic economy from crossing over into the SEZs for 10 years from the effective date of the legislation, the act, which was made effective August 1st, 2016. So 10 years from that date. Now, Jamaica is not the only regime in the world that has such a feature. And the rationale for having this feature is to ensure that the domestic tax base does not get eroded. After all, special economic zone regimes, including Jamaica's, tend to be or are fiscal regimes. They offer fiscal incentives. So, using Jamaica as an example, the regular tax rate is for corporate tax rate is 25%, whereas for the special economic zone, if you're a developer, it's zero. That's quite substantial. For an occupant or a single entity, it's 12.5 with the possibility of bringing it down to 7.75 with the application of certain performance-based tax credits. So the government, from the policy development and from the legislative drafting, tried to ensure that there was a mechanism in place so that the domestic tax base would not be eroded. After the 10-year period has expired, there's a decision. Now, oftentimes it is mistakenly said that after that everybody will be allowed in. That's not the case. The minister has to make a decision, and that decision will be informed by the Jamaica Special Economic Zone Authority, much like it would be for other authorities, would present evidence, data, advice to the minister to say what would be the next move. The minister is to take account based on, Section 7, Sub 2 to Sub 4 of Jamaica's Act, zone development, the level of zone development, how much, GDP contribution, how many jobs, and so forth. And then thereafter, the minister is to make a decision, and that decision can vary. It can be that, everyone gets the incentive. Maybe we're doing such a fantastic job that everyone gets an incentive. Or it could be that the tax rates are reduced, or even the prohibited industries list, which is Section 41, is changed. Certain industries could be removed so that they could also benefit from it, or certain category of businesses, manufacturers or MSMEs. It could be modified so that MSMEs get that tax break. Or the act itself could be modified overall to facilitate such things as what Costa Rica does, whereby if 60% of what you sell is to SEZ, which fosters linkage, is one of the functions and purposes of SEZ, which fosters overall economic growth, 60% is sold to the zone, then you in turn get the benefit as well. That's a possibility. We don't know what will happen in the future, but importantly, this actually sets a timeline. Section 7 sub 2 to sub 4 sets a timeline for the SEZ authorities. It's often not understood or misunderstood. Development timeline. We have from 2016, that is August 1st, 2016, 10 years from that, to have development, to have succeeded in bringing about new zones, more employment, further technology transfer, linkages with the domestic economy, of course, greater value capture in the sense of greater taxes, greater rents being paid to landowners and such and so forth. So that's an important milestone to get a handle on, and Jamaica is not the only one that has such a feature, because zones are intended for a purpose, and that purpose can't go in perpetuity. There must be some timelines and targets set, and we are clearly time bound before the next decision is made. And we're hopeful, we're working hard, just like other zone authorities around the world, to develop our country.